Okay, good morning, everybody, or good afternoon, depending on where you are. This is the Forex Intermarket Analysis Weekly Outlook. Now, what we're going to be looking at today is we're going to be looking at trading intermarket correlations and why they trump conventional indicators, supply and demand basics combined with intermarket analysis, price action trading and ignoring the noise. We're going to be looking at using conventional indicators in a very unconventional way, combining the lagging and the leading indicators to confirm price direction, and a review of the major pairs and how to trade them along with critical yearly price pivots to weed out the noise. Now, just a little bit about myself. My name is Greg Firman. I've worked in the Forex stocks and commodity futures markets for the last 12 years. I am Series 3 and Series 34 retail Forex licensed. I currently also work as a market analyst for TraderPlanet.com since 2008, and I am the owner and operator of eTradeFX. So anybody here that would like to visit me, you can see me or reach me at www.etradefx.ca. So with that said, let's get started. We've got a busy morning here. We're going to try and keep this to around 45 minutes. I always tend to run long, but today I'm going to try and keep it a little shorter and a little tighter to really look at what's going on with these intermarket correlations. Now, right here, you can see I'm using the Vantage Point Intermarket Analysis software to help guide me through some of this price action. Now, we've recently seen a rise US dollar. This has not been going on for a couple of months here, guys, or even a couple of years. This is actually, the dollar is in a bull cycle. These bull cycles that we know, they usually last about 7 years. And in my respectful opinion, this cycle very quietly started in about 2011. And one of the signals to that, the intermarket correlation, was the Aussie dollar selling off once it had hit its high point up in and around that 110, 111 area approximately, and it's basically been going down ever since. So what I'm looking for, what we should all be looking for, is intermarket correlations that are driving the Forex market. Some of the major players here, guys, we're going to talk about them in some degree of depth here, so everybody can leave here understanding what they should really be looking for when they're trading. Now, a lot of different analysts, a lot of different websites, people are getting, in my respectful opinion, again, are getting bogged down in over-analysis. They're looking at Fibonacci, they're looking at Elliott waves, they're looking at a lot of self-fulfilling prophecy type indicators that just really are not leading. They're lagging, or they are giving false signals, when the driving factor is usually a major indice, some of the commodities. These are the driving factors. So what I've done is I've split my screen here. You can see that I've got the US dollar index sitting on the bottom, and then I've got a number of different things up here. Now, one thing I don't hear a lot of analysts talking about is the RBOB gasoline contracts. And this is a little perplexing to me personally as an analyst and as a licensed CTA, is why people are not advising their clients a little differently when it comes to trading the foreign exchange market and even certain commodities. Now, when we look at the RBOB gasoline contracts, the one thing we can assess very, very clearly here is that one is driving the other. You can see that as one goes up, the other one goes down, meaning the US dollar index. So the US dollar index has a very, very high inverse correlation to the RBOB gasoline contract. So basically for the last 2 to 3 weeks, particularly with my own direct clients, I've been advising heavily to buy US dollars only, because there is no reason for me to be selling them at this current time. Now, when we look at this crossover, you can see that this crossover has taken place in the gasoline contracts to the downside, very easy to identify. And as this happened, we can see that the US dollar index has started to rise. It very much likes those RBOB gasoline contracts moving lower. Now, the big move that we've had here today, yesterday, on the RBOB gasoline contracts, it's not a surprise that the dollar has moved considerably higher right across the board in a trending market. And what's even more perplexing to most analysts, they're talking about seasonalities, that the US dollar should be selling off right now. Well, yeah, the dollar is not going to go straight up and straight down, but predominantly we're looking at places to buy dollars based on the seasonality is not the key here. The key here is that we've got major commodities selling off. We've got the gasoline contracts selling off. I rarely hear hear anybody talk about these things. And again, RBOB it stands for basically the gasoline contracts. You can Google that, and it'll give you a definition exactly of what it is. But basically, to keep it short, because I'm on time schedule here, it's the gasoline contracts. That's what it is. So unleaded fuel, the cost of gasoline. So if you're driving down the main street in your town or the city that you live in, I always make this as kind of a joke with my webinars with my own direct clients and say, look, if you're driving down the street every day, just glance and see what the gasoline prices are doing at your local pumps. Are they up or are they down? And always know what those prices are, because if the gas prices are down, then you should probably be selling British pounds. You should probably be selling Aussie, selling the CAD, selling the New Zealand, selling anything that's correlated to those gasoline contracts. So, but if gasoline prices are up and they're moving higher, then you should actually be selling US dollars. And these correlations are virtually indisputable. Nothing's 100%, but this correlation is virtually 90%. And that's the key thing I want you to start looking at, that there is a reason for why these things happen. Okay, they don't just happen. We've got a lot of noise with the Eurozone, everything that's going on there. It really it hasn't even phased me, guys. I really could care less. Greece's outcome is inevitable. There's nothing we can do to change it. The bigger, broader picture here is the gas prices are going lower. Oil contracts are going lower. The other one that is very highly correlated to the RBOB futures contracts is, of course, light sweet crude oil. So when we look at light sweet crude oil, this is very interesting. This has been going on, this move in oil, it was a big move today in oil, which I'll talk about in a minute. But the bottom line is, guys, that when we're looking at these intermarket correlation, this happened weeks ago. And this big move down yesterday and an even bigger move down today, they were inevitable. So when we look at these types of things, we can understand, hey, I don't want to be selling US dollars right now. I want to be looking to buy them. I don't want to buy the British pound US dollar. The British pound has a very high correlation to the oil and to the gasoline contracts. I want to sell the British pound US dollar. So when we look at these things, we get a clearer picture of what these intermarket correlations look like. And we look at gold, we can see the same thing, another big commodity out there. The gold, even with, this is what's very interesting, is that even with what's going on with Greece, gold would usually catch a bid here, and it just simply can't. It's very much struggling, and I'll talk about that in a minute. The yearly opening price around 1182, very, very bearish. But I would have expected gold to move a little bit higher, knowing what's going on with Greece, but not even that is enough to push it. So yes, I can look at the British pound. We can see here that the inverse correlation to the US dollar index. So basically, if we're trading Forex, how could we not be looking at these things? How could we not be looking at the US dollar index, the DXY? We can get this chart, the DXY, the live DXY chart from Windsor Broker, Vantage FX. There's some very good European brokers where we can set up demo accounts. We don't have to trade there. You guys can trade wherever you want. That doesn't even matter. All that matters is that you're looking at these intermarket correlations, so you know that if the US dollar starts moving lower, on a day-to-day basis, week-to-week basis, then the British pound currency futures are likely to go up. Now, if I reverse this setup, and another one I will briefly talk about here, which has been a strong correlation also, is if you're trading the US dollar index, you're trading the euro, you should be looking at the DAX 30, because predominantly we're a little backwards here right now because of Greece, but predominantly we can see that as the European equity markets move lower, the dollar index moves lower. As the DAX 30 moves higher, you can see that these markets are globally connected. Again, DAX 30 chart, you can get it live from Vantage FX. We can see here before Greece, nothing is 100%, but we can identify that there is something going on here here between the US dollar index and the European equity markets, not so much the S&P 500. What's happening here is you've got a QE program. Guys, we've already been through this since 2009, 2008, 2010, up to 2011. The U.S. was in a quantitative easing phase, the same as the ECB is in now. We're simply repeating the same process we've already been through. Equities up, dollar down. So in this particular case, you're simply shifting it over to the DAX 30 and the euro. So if the DAX 30 is down, the euro's up, and vice versa. Don't complicate this. We know how this intermarket correlation works when you throw in a QE program into the mix. This is not rocket science, in my opinion. It's actually a very easy trade, providing we know what we're looking for. So the ECB is just starting their QE program. They've got problems right across the Eurozone, and I'm certainly not saying that the US is without issues. We're talking about the prettiest horse in the glue factory. That's what we're talking about here, okay? So I want to make sure I look at this. So keeping it within my time schedule here, I'm going to try and keep this thing moving so we get a good understanding now what we're looking for. Some of our main correlated markets here, we're looking at light sweet crude oil. We're looking at RBOB gasoline, just basic gasoline contracts. Is gas prices up or down? Is there supply? Is there demand? Is supply filled? Is there demand? These are important things when we look at basically supply and demand areas. Now you can see I've got a number of red lines across my screen and a number of blue lines across my screen. You an indicator to put that on there, or you can just draw them on yourself. But the key thing is, guys, every one of these lines points to a place where it's potentially a buy or a sell zone to me. And that's where we've hit a high, and we've got two candles to the left and two candles to the right that are lower than the highest point. On the downside, we've got a low point, and we have two candles to the left and two candles to the right, minimum, that are higher than the lowest point. That creates a demand area down here and a supply area up here. That also then forms an exponential trend line, which is what everybody should be looking at. I could draw a trend line back here, guys, 10 years, 15 years on the US dollar index. But I really could care less what happened 15 years ago. It's got nothing to do with what I'm doing today. So if I keep it on the daily time frame, the weekly time frame, all I can do is simply shift the indicators. We can see that the dollar index has pushed through this trend line. So when it pushes through this trend line, this just doesn't push through solely because there's demand for US dollars. Part of this, a large part of this, is that we've got commodities selling off across the board. We've got European equities that are up. The RBOB gasoline contracts are down. All of these intermarket correlations have absolutely nothing to do with Elliott wave, Fibonacci, different types of other indicators that we look at based on candle patterns. There's so many different things out there. It confuses the average trader. Keep your trading very, very simple. Oil up, dollar down, okay? Gasoline contracts down, dollar, US dollar up. So you're looking across the broad spectrum of currency pairs to apply that methodology. You're either looking to buy or sell US dollars. So both trades are good. Selling US dollars has been a great trade, but buying them has been even better. Now, when we look at yearly prices here on the dollar index, this is an even more important. You can see if I come out to the weekly time frame, I've drawn a crosshair type chart here. This is the yearly opening price for the dollar index, 90.61, okay? So this is very easy to draw on your MT4, your NinjaTrader, whatever TradeStation, whatever platform you're using. I personally love MT4. Lots of stuff. I can program it. I can do all kinds of things here. So when I look at this, we've never really been below, we've never been below 90.62 for the entire calendar year of 2015. So how could something be bearish if it can't even get below its opening price? We can see that the dollar's been rallying all the way back. If I take this back and take it out a month, you can see that this rally really started to gain traction in 2011. We went sideways here for a few years, but we never made any new lows. We started pushing higher, and we've been driving to the hoop ever since, right? Now today, again, in my respectful opinion, this big push in the US dollar is directly related to this culprit right here. Oil contracts. We've really been pounded lower here today, all the way down to a low of 50.56. And again, last week we were at $60 a barrel. This is a massive move in oil, guys. So the smart trader, the intermarket analysis trader, ignores Fibonacci, ignores Elliott Wave, ignores all of these other indicator-based things in order to see what's really driving the price action here on our Forex pairs. So when we look at this, certain pairs don't stand a chance against this price of this type of a move on oil, specifically the Canadian dollar, the British pound, the Aussie, all your commodity-based currencies. But the British pound has an unusually high correlation also to the RBOB gasoline contract. So I can switch this up and I can say, okay, well, this time I'm going to bring the RBOB up and it's going to be the main one. Which ones are very highly correlated? So I look to the British pound and I see a very unusual thing here, very, very unusual, that, and there can be a slight lag time here, but you can see that the lag is on the British pound side. As the RBOB contract started to rise, a few days later, all of a sudden we get a big move on the British pound, all right? RBOB contracts start to go lower. Well, the British pound starts to follow that down too. Well, then we recover here, okay? We recover this, up it goes again. But lo and behold, when we look at this, we've got a crossover right here. We got a little bit of indecision around this area right here, but this main crossover right here, I believe to be accurate. Now, looking at the massive sell-off that we've had in oil today, last night on TraderPlanet.com, I post 3 recommended trades a week up there, plus a complete Forex weekly outlook. I called this last night before it even happened. The British pound was trading at 156 last night, and I posted a trade on Trader Planet, and I sent it out to my direct clients that were selling British pound today. Just get in there and take the trade. It's fallen 200 pips today. This is not a coincidence, guys, and I'm not going to sit here and put a crown on my head because I'm right or by saying this. The fact of the matter is, I did my due diligence and I looked at what I needed to look at specifically to tell me what's going to happen with the dollar today and what's going to happen more specifically to pairs like the US Canadian, the British pound, US dollar. This is what's driving it. So when oil started plummeting even harder yesterday, by this morning, the British pound didn't stand a chance. It was absolutely decimated. And the USCAD, no different here, guys. This is a very easy setup when you know what you're looking for. So if I look at these gas contracts, it's going lower. The USCAD has not been able to make any traction. Now, a few weeks ago, or actually it was last week, one of my clients said to me, which was interesting, and for the last 7 trading weeks or whatever it was, US Canada's made a high on the Monday or a low, and that's all it's done for the entire week. So somebody posts this article, and then next thing you know, US Canada's made a new high every day since. It's almost like you're being set up. So again, guys, don't read this stuff on these websites. Try and ignore the majority of this because it's just noise. So if you're weeding out this kind of noise, then you're really going to be able to see what price is doing. So in this particular case, I'm not going to argue with this correlation. I can see that as this gas contracts goes up, I'm happy. I'm a happy buyer of Canadian dollars, just to clarify, okay? But I need a reason to do it. I'm not going to do it to scalp. I'm not going to do it just for the sake of doing it. I need a reason here, okay? There is no reason for me to be buying Canadian dollars. There is no reason for me to be buying Aussie dollars, to be buying British pounds. There just isn't. When I look at this intermarket correlation, it is going to trump every other indicator I have. And this can be a very hard lesson to learn, but the proof is in the chart. So we want to take this into consideration before we enter a trade. And again, Windsor Broker, I do not trade there, to clarify. Vantage FX, I do trade there. I like those guys very much, but they don't have the RBOB gasoline. A bit of a trade-off here is the Vantage FX platform. It has the DAX 30. So I can run them both, live or demo, doesn't matter. You get the information you need to do your intermarket analysis. That's the key thing to look at. So when I'm looking at these different things, we're coming into our pairs. We want to do some analysis here. The euro, again, just very briefly looking at that euro FX futures contracts. This is the highest traded currency pair, the euro-US. Euro-US, it's absolutely a big one, excuse me. But what's the driving factor of the euro? So people will say, oh, Greece is the driving factor. Greece is noise, guys. Greece has been trying to separate, or defaulting since what, the late 1800s. I can't be bothered wasting my time with this. I'm going to monitor it, but I really don't care what happens either way. I think that, they're like a spoiled brat child that needs to get their credit card taken away from them for a little while to learn a lesson. But that's all I'm going to say about Greece. I really don't care one way or the other. I'm looking at these correlations. So the RBOB gasoline contracts even has a high correlation to the euro. And the reason it has that is because the RBOB is correlated to the US dollar index. Guys, keep it simple. So if gas is going down, you're selling euro US. If gas and oil is rising, you could be a buyer of euro US regardless of what's going on in Greece. It's probably not the best place to do it, but I'm just saying even the euro has been relatively stable compared to some of the other pairs, surprisingly. So when we look at this, okay, all I want to do is make sure I understand what I'm looking for in a trade. Then I'm going to work in supply and demand areas, okay? Euro's in trouble, okay? So on the daily time frame, always get your footing by coming out and looking at where we are in the current cycle. So if we look at the cycle, I've talked about the bull cycle on the dollar lasting 7 to 10 years. We're about 4 years in. The dollar's not just going to go straight through the roof. The dollar's going to sell off probably next week. But then it'll regain its footing and it'll go back up again. That's what currencies do. But the yearly opening price in the euro is 120.95. You remember we looked at 90.61 on the dollar index. It's an indisputable downtrend that's been going on since about 2011, which confirms that dollar bull cycle. So when I look at this, I always keep that in the back of my mind. Am I in a bull cycle or a bear cycle on the dollar? Because just about everything we do in Forex, in some way relates to the dollar, right? So again, keeping it simple. When I look at this right now, okay, bring it out on the daily, on the Euro-US chart, we're pushing lower. We've got some fractal support area here at 109.51. Not likely to hold. This time of day, I'm usually a little later. I'm a little bit later in my webinar today. We're going into the London close, I believe. But the fact of the matter is it's still pushing down. Now, the other two indicators I have on this screen, I'm going to talk about them for a minute. We can see one is an advanced decline ratio. The other one is a simple RSI on an 8 period. So a way of using a conventional indicator in an unconventional way is 90% of the market participants are looking for overbought and oversold, when an RSI can be a fantastic indicator when it's used differently than other indicators. Okay, so what I'm looking for here is below the 50 line, it's bearish. Above the 50 line, it's bullish. Then you can see I've got a 60 and a 40. What I'm looking for here is now a momentum play. A break of 40, I'm going to sell more. A break of 60, I'm going to probably buy more because it's telling me that momentum is coming into the market. There's a number of different examples I can use here. Okay, I hate going back and looking at things, what they did before. In my line of business, what I do is, particularly what I do with Trader Planet, all the trades are posted the night before. I'm not interested in what's currently happening. I'm calling what's going to happen. Okay, do I always get it right? Nobody does, and that includes me. But I get it right more than I tend to get it wrong, and that's because I'm studying different things. Fibonacci, we're talking about a goat herder from the 16th century. May or may not, I don't know. But why am I taking trade advice from a goat herder? I shouldn't be doing that. Elliott waves. Well, every time they get it wrong, they create a new wave, right? So that's not really doing much for me either. But the intermarket correlations allow me to continue to sell on great. No matter how low it is, I'm going to sell more. No matter how high it is, I'm going to buy more if the intermarket correlations are there. And if I still have momentum in the market. So right here, you can see that the advanced decline, if it's above 1, that means price is advancing more than it's declining, which I find very interesting right now with euro on the daily time frame. Despite what's going on in Greece, it's still technically advancing more than it's declining on the daily time frame over the days. Stuff, right? The RSI is saying no, we're going lower. So in most cases, I really like it when these two agree. When they don't agree, these two indicators right now, they do not agree. Bottom line, right? So that's a red flag for me. So then I have to go over, I'm going to look even harder at those intermarket correlations to determine what the best way to trade this would be. So right now, Shorts. The RBOB is telling me that I believe the RSI in this case is right, and this inevitably, the indicator right now is going sideways. So it's kind of flat, but above the one area, it's saying we are advancing more. So that just throws a red flag. And the euro, we look at some of the smartest minds on this planet, apparently, Ben Bernanke, Alan Greenspan, Janet Yellen, like all these different people, they've all got the euro wrong. Every single one of them have got the euro wrong. This is the most frustrating pair to trade. Any good trader will tell you that. With my own direct clients, I put out trades on euro US maybe 4 or 5 times a month. That's it. I'll hit US Swiss franc, I hit pound dollar, US CAD. The euro is a little too choppy, a little too manipulated for me. Some people say the same thing about dollar yen. That's their choice. But the key thing is understanding how we're combining these indicators to, some people may say that they're lagging. Yes, this is the advanced decline can be lagging to some degree, absolutely. But the RSI is a leading indicator. But leading indicators are not always your best friend either. Just so everybody knows. So when we look at the euro, how we play this is a sell into rallies. I think that we should be able to get down to the 108.17 based on this very strong dollar strength. But the thing we have to watch is we're in Tuesday trade. We're going to have one more good trading day. Thursday is now called what I call reversal Thursday. So whatever the US dollar has done all week, it usually reverses that on the Thursday, and then Friday it goes back to normal again. So what that is, you've got profit taking in the market. So be very, very cautious of that. But I think we should drive down to the 108.17 area. US Swiss franc, which is very interesting. I am going to talk about this for a minute before I jump over to the other pairs. Now, what we're looking at here is that the yearly opening price is normally these two are inversely correlated. One goes up, one goes down. The U.S. Swiss franc is actually still in a pretty strong downtrend, regrettably. It's not just a case of buying U.S. dollars here. We've got the Euro Swiss franc, which is the major pair. U.S. Swiss franc is not a major pair. It's a synthetic cross pair. Okay, the main pair you want to look at, Euro Swiss franc. We know that there's been talk that the Swiss National Bank is at it again. They're in there intervening in the currency markets again. So this is a concern. Be very cautious with this pair. We've got a number of different levels of resistance up here that we're struggling with, but the one I want to see for the rest of this week, I want to see a break of 95.36. That should take us hopefully back towards the 97.98 mark. It's going to be a slow run here, guys, but we need that euro to really get hammered and sell off, which I believe will likely happen. But again, you've got to be careful with these two pairs because they're so highly correlated. Now, when we come into the British pound, looking at our trend line support, we can see that the trend line support was actually broken last week, which is consistent with what I've talked about with the light sweet crude oil, the RBOB gasoline contracts. These are driving factors here, guys, driving factors that are pushing the pound dollar. The pound has an unusually high correlation to both gasoline and to oil. This chart is very clearly identifies that. We can see that we've pushed even lower. We've had a big bar down today. Even though on the daily time frame yesterday, we had somewhat of a bullish close on the British pound. Everybody's getting excited. We're going higher on the British pound. And then today, all of those long traders are just decimated. And this is where you want to be cautious and understand what causes a false break like that. Real money is a buyer of US dollars. We've already identified that. Real money is selling oil contracts, and this clearly they've pushed it, just hammered it lower. So anybody trying to go long on this pound dollar has absolutely been it's a lamb to the slaughter. But you will never be that lamb if you understand these are intermarket correlations. The heavy selling pressure oil came under. That's going to boost the dollar index. That's going to send gas lower. It's going to send oil lower. From there, we can play this. We know what to do here. Sell pound dollar into rallies. So this thing has moved lower. It's gotten hammered. This white line here, 155.75, the yearly opening price. We're now pushed below this. This is your line in the sand, guys. Watch this level like a hawk. This is where it needs to retake this level to take the pressure off the downside. But in my respectful opinion, we are probably going to come down into the 152 area. But we are going to pause on Thursday. you're going to see a round of profit taking here, and that could push the pound dollar up. So be cautious on Thursday. Look for it to stay below 155.75. If we stay below this level, then the pound dollar could be coming back down as low as the 150 area. When we look back when oil was down at $45 a barrel, pound dollar was at about 145, 148. So don't think that this is too low to sell, because it's not, okay? Now, with dollar yen this week here, it is affected by the one thing it majorly affected here is it's by the equity markets. But so what's going on with Greece? If we get some kind of deal, and I'm hearing whispers of maybe a deal again, because all the bank machines, from what I understand, are turned off in Greece, and there's no money flowing. So the newfound, leader of Greece, he's in some hot water here. He's got to do something. So he's going to have to take a step back, and he's probably going to have to suck it up a little bit here and take a deal of some kind, because I don't know what his other choices are. So if he does that, equities are going to probably turn around. Equities turn around, then that's going to help push the dollar yen higher. Now, when we switch this thing up a little bit, again, we always want to look at those intermarket correlations. So when I look at the intermarket correlations, I come back to the dollar. The dollar is usually the footing that I'm always going to come back to, and I'm going to come to this one, the Nikkei. Okay, so there's basically in most cases, this is what's very confusing at this time, but essentially the Nikkei and the dollar go up and down together. Money is either going into the Japanese equity markets or they're going into the Japanese yen. So they've been coming out of the Nikkei based on what's been going on in Greece, because the equities have been going lower, but they've also been buying US dollars. Very interesting play here. So I expect this intermarket correlation to correct itself once the issues with Greece pass, everything's settled down, the Nikkei starts to move back up, and the yen moves lower. That would then push the dollar yen higher. Right now, this is a big level here, guys, and this is what I'm saying is so important with fractals. And I also look at this indicator. You'll see in the left-hand corner that it's a custom design of mine. You can do it yourself. You can just look at the bars. It's just from a single chart. It allows me to look at where we are in every single time frame from the opening of that bar. So in this particular case, you can see on the monthly, we are down 41 pips on the dollar yen pair, but we're up 16 pips on the day. We're down, or on the week, excuse me, we're down on the day. So it's the majority of these indicators are red. So every time a new bar opens, it's down. So we're technically down on the month here by 41 pips. If we're positive on the week, but we need to stay positive if we're going to buy this. Now, the biggest concern I have with this is we really don't have a lot of support down here. The yearly opening price, 119.68. If all hell breaks loose in Greece, we've got a problem here going long. I know that a lot of analysts want to get long on this, but the intermarket correlation is not allowing me per se to get long at this time until this wild card of Greece in Europe settles. Once that settles, then I'll be more confident buying this. But in most cases, the equities don't do great, guys, in July and August. So that's just one more issue that we potentially got here. So for now, I would be a cautious seller of US Japan, and I would look to see this trade really accelerate to the downside if equities continue to move lower and this particular area doesn't hold. But again, the confusion around that is that in this particular case, we would actually be selling US dollars, and that's where I'm struggling. So when I've got a mixed bag like this, I'm going to stand aside on the euro. I'm going to stand aside on dollar yen. There's too much easier money to be made, which brings us to this culprit, the USCAD. This has been a very, very good long trade. This was on long trade was on Trader Planet the night before this happened 2 weeks ago. And again, understanding those intermarket correlation, the CAD didn't stand a chance. Didn't stand a chance on the downs. Any shorts were absolutely again, lamb to the slaughter here, guys. They're decimated because they're counter trend. They're fighting the intermarket correlation. If oil is going down, gas is going down, the US dollar index is going up, why would we ever want to sell this? We wouldn't. We would only be buyers. And these are fantastic this is on the daily time frame. We can see we're up 274 in the month, we're up 169 in the week, and we're up 115 on the day. That's a big move for USCAD on the day, 115. That's a great move. And you can see these bars here, the bars closing in that upper 30% of the bar. That's telling me that the bulls are firmly controlled going into the close. I'm also going to look for that in the lower time frames and the higher time frames. But again, in order for me to sell US Canada, I'm looking for oil to rebound. I'm looking for natural gas, even natural gas. It's a commodity. I'm looking for gold to rebound, oil, gasoline. All these commodities have to rebound, and the dollar has to come under pressure in order for me to sell this. Are we coming into a resistance zone? Absolutely we are. We're coming into a wall of resistance. If we look at these fractal points up here, 128. If we can get to 128, there's virtually nothing stopping us to getting to 130, but we have to clear 128. So can we do that before Thursday? Reversal Thursday. Remember, I'm going to keep saying that. Reversal Thursday, because it's a big thing, okay? So when we understand what actually happens on Thursday, that the best all week the trader's been on, and I've seen this a million times, guys, and years ago I used to do it myself. I'd be on the sideline the better part of the week, waiting, not taking those trades, and then towards the end of the week, I finally decide to jump into the pool, and I get my legs bit off by a shark because I've waited too long. So again, there was nothing telling us to go short here. At any price you went long, you're gonna be profitable on this particular trade. And this is the thing that most traders, they're hesitating, waiting for the perfect entry point. Yes, there is some very good entry points, but there's no such thing as a perfect entry point. Like just get in the trade, right? When we know these things are happening, intermarket analysis is going to give you the kind of confidence you need to say, look, these oil prices are down, these gas prices are down, gold's down, the dollar index is up. I'm a buyer of US Canada. I don't care what all this other stuff is saying. I don't care about this indicator. I don't care about Fibonacci. I don't care about professional sentiment stuff, accumulation, distribute. Who cares? It means nothing. At the end of the day, the other markets are driving this. So we really want to take hold of this and understand how this works, because this is the toughest thing to do, is to simply go out on your own and make a trading decision yourself by looking at these correlated market. A lot of these correlations, they tend to vary from day to day, but predominantly they're always there. So we want to make sure we understand that. When we look at our RSI on the daily time frame, okay? So I can pull this back so everybody sees this. Right there, we break through the 60 mark. The advanced decline, we were already advancing in price, but we've come down, we've touched the 1 level, and then we're bouncing higher. So we keep coming back and down, but the RSI is just saying, look, momentum's taken hold here. This thing is going higher. Now, in your trading also, I would also encourage you to start at the bigger time frames and work your way down, not the other way around. Most traders, they go right after between the 5 minute and the 1 hour chart. They're the last stage, guys, not the first. Come back and look at the charts in the daily, the weekly, the monthly. Have a quick peek. Identify what the primary trend is. Let it go. Let a simple chart go back years and years. And people will say to me, somebody did say this to me on just yesterday and said, "Well, U.S. Canada is too high. I'm not going to buy up here." And I said, "Well, why is it too high?" And there was a long pause on the call, and I couldn't get an answer. All he said was, it's too high. There was no rationale behind that, okay? U.S. Canada in the 1990s, this was at $1.60, guys, $1.60, $1.55. This is not too high. We're thousands of pips off of where it could potentially go to. So you want to try and take your mindset, change your mindset a little bit and say, most of your junior traders, most of your inexperienced retail traders, they love to go against the market at a high or a low. And, set by CFTC data, 75% of the traders are not making money in equities, Forex, all these things, because they're constantly fighting these correlations. They're fighting the market. You don't want to beat the market. You want to join it. Okay. So I'm going to finish up with 2 more pairs. I'm going to hit Aussie US, New Zealand US. Aussie US. When we look at this thing, I've got it on a weekly time frame. Again, I can come out to the monthly. We can see here's those high points that I talked about. So let's identify these. This is basically where Aussie US made its top, right up there. Okay. Right up in that area that I talked about. Has it gone higher than that since? No. And quite frankly, it was utterly ridiculous that this currency got that high to begin with, but it did. And once again, I can't fight what the market's doing, but clearly the market is selling this. Okay, there's just no ands, ifs, or but it. If I look at the date here, okay, the bull cycle that I talked about right there, June 11th, 2011. So does this mean that Aussie US is not going to go higher? Of course it's going to go higher. But guys, we have to have a reason to buy this pair. And I look at all the different websites. They said, okay, Aussie formed a base at 108. Then they said, okay, Aussie's formed a base at 96. And then, heard it again. Aussie's formed a base at 90. Nope. Then, okay, Aussie this time for sure, 81.60. It's formed a base. Guys, now we're down at 74. Okay, so this is what I'm saying. This is clearly moving down, and it's been moving down since 2011. Bottom line, when it forms a base, then we'll see how that works. One of the questions coming through, do I consider economic data? I consider data from central banks, the ECB, the FOMC. I look at employment rates out of the U.S. Most of the economic data that I would focus on would be U.S.-based because it's the only common denominator that I have through the Forex market, that basically we're either buying or selling U.S. dollars. And remember those cross pairs, guys. Euro Great Britain, Euro Japan, Great Britain Swiss franc. Great Britain Swiss franc, no such thing. It's Great Britain US and it's US Swiss franc. That's what it is. So the US dollar is even in that. So the US economic data, kind of important, but most of them, I don't care so much about GDP. I do watch the CPI. I'm interested in that. The FOMC. Some of your basic data, but most of the other data, durable goods, GDP, it's not a big market driver here. At least it hasn't been in the past. So kind of keep that in mind too, right? We don't want to get overly complicated in some of the things we do with these. Most of the people, they say when the economic releases come out, half the people don't even know what it means. So they're long, they're short, they're in, they're out. That's what causes that wild swing. In most cases, during a non-farm payroll or an FOMC, we got the minutes tomorrow, I would just tend to clear out my positions prior to that because the FOMC is notorious, just like the ECB, for talking out of both sides of their mouth. You cannot predict with any kind of certainty what they are going to say. And they change their rhetoric, and then they just say that, oh, that's not what I meant. That's not what I said before. Okay, I said it, but that's not what I meant. So you don't want to expose yourself to that kind of stuff. But, usually the intermarket analysis, the intermarket correlations have already taken hold of the market and something's going to happen. So when we look at this Aussie right now, again, we've had a real nice channel that's been running along here since April 2015. I have maintained on Trader Planet with my own direct clients that we only sell this into rallies. The yearly opening price, 81.66. You can see that the market came right back up to 81.66 on basically the mid-May of this year. And I just sold it based on nothing more than that yearly opening price and the intermarket correlations to oil, to gold, the dollar index in a bull cycle. This is the easiest trade I've had, and it continues to be the easiest trade I've had in 2015. But whenever I've tried to go long, and I went long on this last week, trying for 20 pips, guys, I got stopped out. I couldn't even make 20 pips on this thing. And once again, just goes to show you're professionals. When you think you can make 10 or 15, 20 pips and get out, you end up losing 50 or 80. This is what always happens because I'm not going with the market here. I'm fighting it, right? So, that I'd already made 80 pips on the day on this particular trade on Aussie US, and I just got greedy. And I went against what I had done the first time. So, lesson learned. Am I going to do it again? You know it, because that's me. I make the same mistakes that everybody here does. Now, I'm not saying everybody here makes mistakes, but I'm sure we all have done things like that we think it's such an easy trade. And it turns horrible within minutes. It's just your gut, you get that feeling in your gut going, why did I do that? So always look at those intermarket correlations. When we broke through this trend line here at the 75.88 level, when I got stopped out on my long trade, I immediately went short, and I'm still in that short now. These are the kind of trades that make money, not fighting the market. So most people, I'm not selling Aussie US at this level. No way. Guys, it's dropped another 200 pips since, right? So let's, really look at these things. Our indicators here, our advanced decline, the RSI breaking through that all-important 40 line on the D1 time frame. There's just no long trade here. There will be a long trade here in the coming weeks. It'll probably retrace. Will that have something to do with Fibonacci? Not likely. It's just simply going to. You're going to run out of sellers here at some point, and this is what currencies do. They flush out all the people. The people that are going long on Aussie US over the last couple of weeks have just been slaughtered, right? And they are going to keep hammering it lower and lower and lower until they flush out every single long trader here. And then it's going to go up 500 pips. We've seen this movie. I've seen this movie 1,000 times. It's not ready to go up yet. It may be soon. Keep an eye on some levels here, but be very, very cautious with this pair. Okay, Aussie tends to wander around, does its own thing. We're down 278 on the month. We're down 51 pips here on the week, down 71 on the day. Big move down. So, the further the market moves away from the opening price, so basically what this monthly indicator, it's just simply telling me where I am. Am I from July 1st? I'm already down 279 pips. So the further this number gets away, the bigger this number gets, the more likely it's going to retrace. I don't need to put a Fibonacci on here to tell me that. We are going to run out of sellers down here. I think we're close to that now. I think that maybe another 100, 150 pips, the big banks, big traders will be satisfied that they crushed all the retail traders, got them all stopped out, and then it goes flying higher. And then those guys, those retail traders, or even some of the hedge funds that finally jump into the pool and go short Aussie US, that's the moment it's going to turn higher. So remember that. Before you get too excited about getting into jumping into the ocean, you might want to put your toes in there first to make sure that that there isn't a shark swimming right there waiting to bite your feet off. And that's what helps. FX Boyke is asking gold. I don't know. You have to gold. I'm not sure what you mean. You just wrote gold. You want me to look at gold? If you could clarify that would be of assistance. The gold chart is right here. We can see the gold chart to the Aussie US. It's consistent. Gold's been going down basically since the dollar stopped falling. If we go back, we look at this, gold's been a little bit better, but once we've hit those high points, and again, when it comes back to there we are again. Okay, so this is consistent with pretty much what I've said on the dollar bull and dollar bear cycle. If we come down, there we are, guys, June 2011. So pretty tough to argue with that, and gold's been going down ever since. Right? There's been no new high, and it's been going down ever since, and it's going lower as we speak. So these are the kind of things we want to make sure that we're looking at. Okay, so the Aussie has a very high correlation to gold. So if gold can recover, Aussie's going to recover. Same as my final pair here. I'll have a quick peek at New Zealand. We've got some. Yep, China. Alan said China stock market on the Aussie. Yep, that's something. That's another intermarket correlation you can absolutely keep an eye on. China rate cuts, China economy in general has been a little softer. All that's putting pressure on the Aussie. So there's a number of different factors that drive it. But the reality is, we get day-to-day noise that confuses things. The fact of the matter is it's still related to that US dollar. It's still correlated to that dollar. It's still correlated to commodities. They're going to continue to keep pushing lower. So when I look at this, New Zealand, once again, guys, this is not a difficult trade on the short side. It can be, I know that, on the shorter time frames, but this is a much smoother looking chart. We've got up a little bit up towards that 77, 60 area, and then down it goes again. And once again, the traders look at this and say, oh, this is as low as it can go. I'm going to buy here. But it just never seems to work. Right now, the Aussie is coming up against some very formidable support here. Which time frames do you trade them on? Basically what I trade them on, time frames I'll trade them on. I'm going to start on the higher time frames, okay? And then I'm going to work my way down. and I'm going to look for any areas to enter this trade, right? So I could use the daily, the weekly, but I'm going to try and pick up a decent price on the 1 hour time frame, the 4 hour time frame. Maybe at times I'll look at the 30, but I got to be careful. But the main thing is come to your daily first, identify the trend, and then start coming down. So if I look at New Zealand US right here, the monthly, the daily, the weekly, excuse me, very ugly, the daily, ugly again. 4 hour, okay, still no sign of, there's still no trend line down here, guys. There's still no demand area. So the lower trend line is called a demand area. Here we are in the hourly, still nothing. So right now, there's another indicator you can use too, just to simply calculate the average daily range, which provides assistance. We've got 66.43 and then 67.21. So this is just a standard indicator. You can get it on different websites that calculates what the average high and low would be for the day. Because in most cases, currencies tend to just move kind of sideways. They make a high, then they go after the low, and they only really trend, about 25% of the time. So what you want to look at is, again, identifying the direction, and other times I'll come right to the daily time frame and I'll trade off the supply and demand areas, off the trend lines, off the daily. Excuse me, and then combine it with some of the additional indicators, but just simply look for consistency. Another great trick here, guys, take the D1 and the H1 and look for the two to match. So what I mean by matching is you can look at a trend line on the D1, you can look in the D1 and see if something's advancing or declining, and if they match, trade in that direction. Right now, New Zealand US, the H1, the H4, the D1, the advanced decline, they have matched for weeks. The RSI, they've matched today. Again, they've matched. Now you can see New Zealand starting to push higher, right? We're not above the 60. There's no momentum trade here, but the trading day is done. We're 5 to 12 Eastern Standard Time. Once this time of day, things just dry up. So don't get too excited about trading at this time of day. Just going to check some of the questions here because I am going to have to wrap up. Which time do you freight? I think I've answered that. All sounding terrific, as you always do. Thank you, Terry. I appreciate that. One important question. Do we still need to close up Sunday night for the Euro gap? I think right now, Terry, I think you would be smart to clean things up on Friday and try and have everything cleaned up and closed by Friday, if at all possible, or back your stop way off. Now, quick little note on what happened to me last week is that I went into the non-farm payroll and I was short Great Britain US. Before the payroll number came out, I had locked in 20 pips of profit. But the problem is they didn't fill me until 156 and change. So the winning trade I had actually turned into a loser. So that, remember, and we should all have a lesson here from those snakes at the Swiss National Bank when they took that peg off. A lot of people really got hurt by that, right? And the brokers couldn't fill those trades. Now I'm seeing the same thing on just normal day-to-day volatile announcements like the non-farm payroll. And that's why I was saying I like to clean things up on that because it's a problem. It is a big problem. Which moving average, FX Boyke? You got to be more clear, man. I don't know what you're saying here. The white line? You mean the moving average I'm using on the screen? Yes. Okay. This moving average. This is a 50-day simple moving average based on the high-low closed. I also use 100, and a lot of people, I believe, Horner, I forget her first name, very interesting. The 34-day moving average is also one that I tend to look at times, but I think that the majority of the market really does like the 100 or the 50, and they do like the 200, and I'll move it back and forth. But if I'm in a shorter time frame like this, I'm going to go down to the 50 on the 1 hour time for Ragni Horner. Thank you. I just drawn a blank there. Sorry, I've been on for an hour here and I couldn't remember her name. And she's a great girl to follow. Okay, let's see. I'm going to clean up some more questions. Terry. Okay, well, Terry, you can visit my website. I'll type it in here, www.etradefx. I am in domiciled in Canada. That's what the .ca is, and I'm happy to talk to anybody that was on the webinar here today. If you have any questions about the presentation and the things that essentially we've gone through today. And, you know, what I'd really like to do is, I got one more question here. What is your signal for entry? The signal for entry, guys, if I'm trading the Euro US, for example, I'm going to say this real quick because I'm running very long here, is I will look at an intermarket correlation before I will look at the main charts. And once you know these intermarket correlations and you set your charts up like that, before I look to the currencies, I look to the equities, I look to gold, I look to oil, I look to RBOB gasoline. I see what they're doing. And are they up or down on the day? Are they up or down on the month? If they're all down across the board, then that's going to give me the green light to go buy US dollars. And then I'm going to look at that and identify how to get into that trade. So, and, you know, looking at, you know, swing lows, swing highs, the fractal points are fantastic things to use because they're already telling us an area where the market has paused, has come to an area, and for some reason it stopped. So if we look at this, I'll do a quick analysis for you here. I'm on a 1 hour time frame with New Zealand US, right? So I'll look at this area right here, and you can see that as this market came down here, most people are going to try and buy right here. But in actual fact, all of our indicators tell us the commodities and everything that's going to lower. So the second it breaks through that basic fractal point, I would sell right here, okay, and go down. Then trail that stop. If I'm using a 1 hour time frame, if I'm trading off a D1, I could be looking for a much bigger move. But you know, depending on what the conditions are. So I am way over my allotted time, and you know. What I'd like to do is take the time here to thank everybody for coming out to the presentation here today, supporting FX Street, supporting the webinar presentation I've done. I try and make sure that I bring something new to the table with intermarket analysis because I'm sure you guys have heard everything from Elliott's to Fibonacci's, moving averages, crossovers, everything out there under the sun. So I try and bring it down and bring us into something that we can really action in our trades. So once again, guys, thanks very much, and I look forward to seeing everybody next week. Thank you.